So hi everyone, thank you for joining us today, and thank you Todd for speaking. It's great to have you. So Todd has over 30 years of experience as a tax practitioner and is a senior partner at Quantum Business Law. Todd is well known across Canada as an educator in the tax community. He's lectured extensively to thousands of accountants and lawyers, to groups including the Canadian Bar Association, the Ontario Bar Association, and the BC CPA Association. Todd has also authored numerous articles on Canadian taxation. In addition to Todd's duties as a partner, he directs a team of lawyers, accountants, and tax consultants who provide corporate reorganization strategies to business owners. So thanks again for speaking today, Todd, and good luck with your presentation.
Well, thank you very much, Alex. Appreciate the opportunity to speak to the group. I think as a starting point, we can talk a little bit about some of the challenges that are common to entrepreneurs, in particular shareholders of Canadian-controlled private corporations. In my view, there's many areas that need greater attention. Often we see companies that have lost capital gains exemptions. We see situations where, although there is an intent to achieve intergenerational transfer of wealth, really nothing has been done in order to provide for the introduction of family members as shareholders and positioning oneself so as to mitigate the amount of tax that's payable either at a liquidity event, such as the sale of a business, issuing of an IPO, or ultimately death. Interestingly enough, all of those eventualities have the same tax consequences. We have a disposition of shares of a corporation. And of course, in Canada, we don't have estate taxes like they do in the US, but we do have these capital gains taxes. And one of the things that is often overlooked is whether or not the shares of your company are in fact eligible as qualified small business corporation shares. We know that there's been an increase, and every single year there's an increase in the limit or the amount of the lifetime capital gains exemption. This year it's a little over $892,000. We see a lot of misconceptions. We see situations where people plan their affairs in a way that ignores the capital gains exemption. Well, there's a couple of things as precursors to what I'm going to be talking about that I'd like everyone to think about. And that is, first of all, and please keep this firmly in your mind, that only individuals are eligible for the lifetime capital gains exemptions, not corporations. That means if you have an operating company, the shares are held by a holding company, please make it clear and please remember that the holding company cannot sell the shares of the operating company and claim a capital gains exemption. Some other issues exist as well. And if you go on to the next slide there, Jeremy, you'll see that there is some issues here that we have to be very careful of. The eligibility for the lifetime capital gains exemption is not an automatic entitlement. There's a three-part criteria that you must meet in order to be eligible to claim a capital gains exemption. First of all, a corporation must be a Canadian-controlled private corporation. And I'd like you to focus very closely on the three-part criteria. First, all or substantially all of the assets of the company must be actively used in Canada at the time of a disposition, a sale, a liquidity event, an IPO, the death of a shareholder. And that's something that I see all too often that's ignored. We see situations where people, successful entrepreneurs, are never advised that as cash builds up inside of a company, we essentially lose this very important opportunity to claim this exemption. And it's not only one exemption, it may be many. It may be that you can multiply the capital gains exemption to include various family members, spouses, children, perhaps grandchildren who are not even yet born. I'm trying to suggest to you that this is critical. Some people say, well, I don't think we have that problem. Nobody's ever told me. Well, I'll ask you a couple of questions and you can think about that. Within your operating company, and by extension, within your holding company, if you happen to have one, keeping in mind what I said earlier, that corporations are not eligible to claim capital gains exemptions. If you're ever intending to claim a capital gains exemption on the sale of your holding company or your operating company or at your death, then please remember the cash, and you'll be shocked, cash is a bad asset to have in abundance inside of your company. The term all or substantially all generally means 90%. So one could paraphrase or rephrase this to say that 90% of the assets held within your corporation should be actively used in the business in Canada. Well, what if you have several $1 million, even hundreds of thousands of dollars of cash sitting inside the company that's essentially unused? Well, could that present a problem? I've had people say to me very recently, well, what is it? The government is trying to prevent our success? Well, on the contrary. In its wisdom, the legislature had introduced provisions to assist businesses, but not on the basis that cash is hoarded. Yes, cash is a bad asset from a tax point of view. It's also a bad asset from the standpoint of vulnerability to litigation. If somebody sues you and you're sitting on a lot of cash in your operating company, well, that could disappear very quickly. If you've moved money up to a holding company, and we'll talk about that in a minute, that presents another problem. But let's move forward and say that there are two other tests. The second is that for a period of 24 months, you must have at least 50% of the assets in the company as active assets. And again, please understand, I'm not just talking about any old assets. I'm talking about anything that isn't essential to the survival of your company. There's two court cases that I'd like you to think about. One is a Supreme Court of Canada decision, and the other is a Tax Court of Canada decision. And both of them are very daunting for businesses that are successful, that are ignoring these rules. In the first states that the cash in a company or assets in a company that's unused must be a mandatory precedent to trade. In other words, you can't run your business without it. The second decision states that if you withdraw the cash or other assets from your company, then it would have a decidedly destabilizing effect. So if you have money in a GIC, marketable securities, in investment real estate, or again, simply in a large amount of cash in a checking account that you're not using, well, the CRA may just disallow your capital gains exemptions, which is very costly. So let's move on and let's look at more of a diagram, a representation. What do we got here? Hold on. Before we go on further, let's talk a little bit more about some other things. I'm going to get to that in a moment, but there's some pretty important stuff here that I think most business owners in Canada and run small and medium-sized companies ignore. We see very large companies, and we've done work for billionaires that also haven't necessarily given proper attention to some of these very, very important things. So the first thing to understand is if you hold the shares directly of a corporation, whether it be a holding company or operating company or a spider web of different companies, if you're at the top and you're holding those shares, somebody sues you, guess what? You could lose your whole empire. Vulnerability to litigation is very, very important. We've talked about the fact that assets sitting inside of a company can cause a serious problem from a tax point of view. You can lose it that way, and you can also lose it through getting sued. So the reality is there's many ways that you might run into difficulties. Section 160 of the Income Tax Act can have the effect of a negative assessment against an underlying corporation, whereby a dividend has been paid up to a holding company where there's no money to pay for the assessment in the underlying company. CRA can use Section 160 to go after a dividend that's been paid up into a holding company. Let's have a look at some of these slides now and see if we can make sense of all this. The issue with tax, and to quote the Donald Bowman, who I've worked very closely with for a number of years, former Chief Justice of the Tax Court of Canada. Someone asked him once why he went into tax law. He said, well, there's lots of different areas of law. There's corporate law, there's criminal law, there's state law, all different areas, but there's one area that affects everybody, and that's tax, right? Everybody pays tax, everybody's affected by tax. And the problem that we have is that we see lawyers and accountants working in silos. We see issues getting ignored. Oh, we're setting up a new company. Where are we going to put it? Oh, just put it under holdco. We end up commingling assets, and I find that quite objectionable. So I'm pleading with everyone in attendance today that is involved with tax planning. If you're an accountant or a lawyer and you're doing work for your employer, your client, or whomever you're involved with, I'm asking you, please, to consider the common yet very onerous position that one puts themselves in by moving these assets out of the operating company into the holding company. So in this particular case, I'm going to argue that in many cases, well, there's no capital gains exemption. because of the fact that it just makes sense to move that $1 million up. Well, let's talk about some other situations we often see. Next slide, please, Jeremy. This is a situation where people set up a separate company for special purposes, say to purchase a building. And let's just say, for the sake of our discussion now, the operating company occupies the building. And in order to protect the building against a claim from a creditor or a lawsuit, we set up a separate corporation we'll call RealCo. And we loan money. One year we need a new roof. The next year we need to repave a driveway. The next year we're maybe buying another building. Who knows what we're doing? We have loans going from the operating company to the RealCo in order to fund some of the maintenance issues or acquisitions. How many in attendance have done this? How many in attendance have seen this with their own clients or people they represent? Well, I'd suggest to you that this can be a serious problem on two levels. One, there's an expression in litigation that all assets are exigible. And really all that means is that any asset sitting inside of the OpCo, the operating company, can be attached. If there's a claim against the operating company, the loan is what? Where did it appear? To all you accountants and attendants, it appears on what part of the financial statement? Yes, that's right. In the balance sheet, it appears on the asset section, doesn't it? It's an asset. The loan is an asset. It's an asset because it has issued a loan to the real estate company to purchase a building. Well, let's just say there's a claim against the operating company where there's insufficient assets and we have this very valuable property. Well, if they come to our firm, my partner, Michael Miller, we may just say to them, well, let's just have a look at their corporate structure. Michael might look at it and say, let's take the loan, we'll call the loan, and then we'll force the RealCo to pay us. Oh, RealCo doesn't have any money, don't worry about that. Not a problem. Michael will endeavor to force RealCo into bankruptcy in order to pay for that. So reasonably speaking, these assets aren't safe anymore. We've really defied the very reason that we started out doing it. And the other reason is that the loan may not be an active asset either. In other words, you could still lose the capital gains exemption that otherwise might be available to you. Anyway, let's go on from here. Let's not belabor this too much. So we're talking about the presence of non-active assets. And let's go back to that first slide if we can. The one, yeah, that one right there. Right, yeah, that's good. No, after that, there you go. All right, so we're talking about the fact that the shares of the holding company should be pure. Unless you've done an estate freeze, and I'm sure that a lot of you have been involved in estate freezes, and if there's 100 people in the attendance or 200 people today, well, and you're all accountants, well, I would assume that perhaps there could be 100 to 200 ways of doing an estate freeze. But we're going to talk about estate freezes in a few minutes. But if you've done an estate freeze, it might change things a little bit. But if we have an operating company where the common shares are held by the holding company, we've talked about the fact that there's a need to move that cash out. Well, those of you that have that situation, no need to despair. I would suggest to you that we can purify this company. And this can be done through a series of transactions that are intended to transfer cash from an operating company, or in this case, to a holding company, into a newly formed sister company. I'm calling it a sister company because it has the same parents. And this can be done on a tax-free basis through a series of transactions that can allow you to be able to achieve two very important things. One of the things it helps you to achieve is ultimately the eligibility for the capital gains exemption that otherwise would not be available, because $1 million of cash sitting in a company would require that you have $10 million of active assets, because 90% of the assets must be active. All or substantially all of the assets of the operating company or the holding company must be actively used in the course of business. To make it worse and to amplify this situation a little bit more, I'm not sure how many of you are aware of this, but the bar is higher where you have an operating company and a holding company stacked together. These are called the anti-stacking rules. The anti-stacking rules provides that you must meet this higher threshold for 24 months. That means 90% of the assets must be actively used for the whole 24-month assets must be actively used in business for 24 months before you die, before you sell the company, before you pass it on to the next generation. And by the way, we work with accountants and lawyers across Canada on assisting with complicated tax matters. And there's something that I keep hearing, and that is, oh, the holding company won't have a capital gains exemption. Well, of course it does. The operating company is an eligible qualified small business corporation, and the value of the shares and the definition of a small business corporation are met in a holding company normally. The definition for a qualified small business corporation shares are different because it deals with the issue of whether or not we have these active assets. That's what you need to keep in mind. So essentially, what we're describing here is doing planning with tax benefits in mind, not just simply a holdco because it's what everybody does, or a real co because you think you're getting asset protection, and you might fall into a trap where you're not getting any asset protection at all. I don't know if anyone in attendance ever used Lego blocks as kids, right? Well, that's what we do in tax planning. You know, when you look at complicated structures, you might have 20, 30 different companies, triangles, squares, oval shapes. What do all these things really mean? How confusing really is it? Well, I'm here to take the mystery out of all that chaos, right? So essentially what I would like to point out to you, the Investco, or one might call it a Cisco, well, there is no capital gains exemption in that corporation. And there's no small business deduction either, right? So what I'd suggest to you is it's wise to start to consider ways of separating active assets to your left from the non-active assets to your right. You can make real estate acquisitions. By the way, please don't buy personal use property inside of corporations. It drives me crazy. I can't tell you how many times I get calls from accountants and lawyers and clients, and what they've done is they've gone ahead and they've bought a condo and thinking that it's okay, or we're using it personally, we're paying market value rent. No, it doesn't work. Okay, CRA can assess it in two different ways. One of the ways they can assess it is whether you're paying fair market value for that property. Second, you know, if the property has a value of, say, $1 million, then what would the company expect to earn as a reasonable rate of return? And that's the amount that could be assessed against you. And it's not whether you use the property, it's whether the property is available for your use. But if you are going to use it, anyway, keep those things in mind. Let's get the personal use property out of corporations. Let's move on to the next slide just for fun. So we're talking about estate freezes. What is an estate freeze? When do you do an estate freeze? Why do you do estate freeze? How much assets do you have to do an estate freeze? I'm going to say that this is one of the most beneficial yet underutilized tools in the Canadian tax planning arsenal. And in the US, we can't do estate freezes, but we do in Canada. It's one of those things that are ignored for reasons that I'm not 100% sure of, probably because they're not very well understood. Many things that are not very well understood are avoided, not discussed, perhaps swept under the carpet. But if you're involved with a company that's growing exponentially, at what stage do you do an estate freeze? Well, I'm going to say at the beginning. I'm going to say set it up properly. It's out of the gate. So, okay, let's take a step back. What is an estate freeze anyway? Well, when we die, the first person at our funeral is Her Majesty the Queen, and she has a big bag that she wants filled with cash. Well, my job is to make sure that she doesn't get too much. I'm joking. At the end of the day, that's kind of the idea, though, isn't it? The fact is that when we die, our assets are deemed to be disposed of, and for purposes of calculating capital gains taxes, the fair market value of the asset immediately before death is taken into account in determining what the amount of capital gain to be paid should be. So when you do an estate freeze, well, let me just put it in real simple terms. We freeze, we limit, or cap the amount of tax that has to be paid on death or when you sell the company, right? So how do we do that? Well, if you go inside of a minute book, say, right, you go into the guts of the corporation, you'll see that there's articles of incorporation there. You'll see there's share provisions and all that stuff. Well, those are important things. Those things are important because there's shares that we can create if they don't already exist that do not grow in value if you are advising a business owner, or perhaps you're a business owner yourself, and the value of your company is growing, well, so will your common shares. Well, the state freeze can be achieved, like I said 10 minutes ago. If there's 100 people or 200 people, there's probably 1 to 200 ways one could do an estate freeze. But essentially, it means that you're exchanging common shares that grow in value for preferred shares that never change in value. So we do a valuation of your operating company. If you have real estate assets, we get an appraisal of those things done. We determine what the shares are worth. And then we do what's called rollovers, right? And of course, those of you who are accountants and lawyers are familiar with what a rollover is. There's 86s, there's 85s, there's 51s, there's other ones too that deal with partnerships. The world of tax is confusing. And the point is, it doesn't need to be. So instead of asking the question, how old should you be when you do an estate freeze? How much assets should you have? Ask yourself, is the company likely to grow in value? And if the answer is yes, then you should be considering an estate freeze in order to mitigate, cap, or limit the amount of taxes you're paying later on. Let's have a look at a standard purification estate freeze slide here. So Jeremy's just set this up here and drew this out for us in a way that makes it very, very clear. We have an operating company at the bottom. We see that it keeps paying dividends up, an intercorporate dividend on 112.1. There's no tax on intercorporate dividends. You're moving money from the operating company up to the holding company. Well, that's great. But rather than having it stop there, for crying out loud, let's do something about it to provide a conduit to move that cash out of that holding company so that you can achieve better protection and so that you don't lose your capital gains exemption. So on the top left there, you see we're talking about the entrepreneur having freeze shares. Well, what are freeze shares? Freeze shares are essentially preferred shares. The entrepreneur has undertaken to do a rollover, having the effect of exchanging his common shares that are growing for preferred shares that never grow. That's it. That's your estate freeze in a simplified way, right? Then we go a little further. We say, okay, let's do some planning because we have family members we'd like to bring in as shareholders, directly or indirectly. And one of the problems with just giving shares to people, once you, there's many different areas of concern there from an asset protection point of view. Many of the wealthiest people in Canada are seeking not to own anything and to essentially transfer all their assets into a trust. The 7th Duke of Westminster, who comes from, I think, very good lineage, since the second Duke of Westminster is noted for the famous tax case that the GAR system in Canada, the General Anti-Avoidance Rules, have been essentially created from, forming the backdrop of our GAR system, or the Anti-Avoidance Rule system. And essentially says that if a taxpayer decides to order his affairs in a fashion that he pays less tax than, even if the tax authorities don't like it or it's unappreciated by his fellow men, then tough, right? It's his right to do so. And he should not be compelled to pay the higher rate of tax. So in effect, this 7th Duke of Westminster had received somewhere in the order of $9 billion and come under severe criticism. The way that it was done, it was commuted through a family trust that he was a beneficiary of, where he basically paid no tax whatsoever. Trusts are one of those things that I think are a very important part of tax planning, and one that tends to mystify people. And again, I think likely, just like an estate freeze is somewhat confusing, the concept of trusts is also confusing. So let me start off by telling you that trusts and the law of trusts is rooted in antiquity. Common law provisions for trusts are well established. And a trust is basically an arrangement. It's an arrangement between, say, a business owner, an entrepreneur, and his family members. The thing to be aware of with trusts is that trusts are intended to protect beneficiaries. And the beneficiaries of a trust would normally be the entrepreneur and his family members, his spouse, his children, his grandchildren, and so on. The trust began about 900 years ago, and they were popular back in the days when the holy wars were being fought. They weren't sure if they were coming back, and they needed to have a provision in order to kind of hold these assets. And that's basically the birthplace of trusts, if you will. Trusts are essentially created by a settler or an individual who settles a trust or makes a financial contribution to a trust, perhaps a modest amount, maybe a $10 bill or a $100 bill. And essentially the trust becomes settled, and there are different parties to trusts. We have the trustees. Well, in this particular case, well, I'd say probably the trustee would be the entrepreneur, perhaps his wife, and perhaps what I might call a friendly stranger. And then the other parties to the trust is the beneficiaries, which would be all of these individuals. Now, in order for the trust not to be deemed as self-dealing by the CRA, we tend to find it important that we add a friendly stranger who would be a third trustee if you want to, in fact, have the entrepreneur and his spouse as beneficiaries. Now, once this trust is created, and trusts can take a lot of different forms, but in this particular case, I'm talking about a fully discretionary trust. In other words, it's up to the entrepreneur and his spouse to exercise their discretion during their lifetime to decide who amongst the family members would receive assets. Well, let's talk about what the assets are. So let's take a step back one more time. The entrepreneur exchanges common shares for preferred shares, having the effect of freezing the value of those shares. And then what we do is we issue brand new shares in the holding company that have a nominal value, perhaps $1 each. We issue 100 shares at $1 each. We have the family trust subscribe for those shares. Now what happens is, assuming that we freeze at a value of $1 million in the hands of the entrepreneur, and say the company grows to $5 million, well, then you'll have $4 million in the trust and $1 million in the hands of the entrepreneur. The critical thing to understand is that no matter what the future value grows to in this operating company and holding company, the preferred shares will always be worth $1 million, unless, of course, something happens with the company that causes a reduction in that million, and then you can do what's called a refreeze. But this is a very simple way of achieving many things. I'm going to say 5 things, and I'll cover them in a moment. What we do is, in addition to using the children and family members as a beneficiary, we set up a corporation we call Investco. And essentially, you can see that there's lines that go between OpCo and HoldCo, where you'd pay a dividend tax-free up to the holding company. The dividend, if you go back to the prior slide for a minute, Jeremy, the prior slide shows the dividend flow, all cash-free, tax-free, sorry, not cash-free. You'll be cash-free in the holding company, is which we want to be, and you'll be cash something else in the Investco. You want to be cash-rich over there. And then you can invest in real estate and other investments, and you've created a dichotomy, a division between the operating company and the active business. We have about 3 minutes left, and we could probably go much, much longer. I'd like to talk to you about superior asset protection. In Canada, we have legislation that's known as the Fraudulent Conveyances Act. The Fraudulent Conveyances Act essentially provides that if the court should see fit, it can make an award where an individual has attempted to hinder, delay, or defraud a creditor. And in this instance, there's things that you can do to protect yourself in jurisdictions outside of Canada if you have significant assets. Family courts are, as an example, they're courts of equity as well as courts of law. And the family courts have been known to make awards that can, in some ways, work against the interest of debtors, right? Canada has sadly become a creditor-friendly country. And as such, it would be wise to consider, if you have significant assets, what could be the effect of a claim against you where you've moved assets from one company to another, and you've done so in a way to cause assets to be, or creditors to be hindered. This is called the Statute of Elizabeth. It's from the 16th century. It's archaic legislation that Canada essentially has adopted. It's provincial legislation. It's in every province. It's known by a slightly different name. But if somebody's suing you personally and you have moved money around or taken it out of your company, you might have a problem. The flagship case is called Ottawa Wine Vaults versus Maguire. In this case, the Supreme Court of Canada ruled Maguire should not only have considered his existing creditors, but his future creditors. Let's go to the very final slide. We've got about 1 minute left. And as you think about all the things I'm saying, I'm suggesting to you that I'm going to suggest swap Ontario trust or a BC trust or Alberta trust for a foreign trust in a jurisdiction like, say, Barbados, New Zealand, possibly Wyoming, Nebraska, Alaska. There's a lot of things to do to protect your assets by putting them under the control of a trust with a corporation acting as trustee. You can protect your assets in a way that can't happen in Canada. And by the way, save the best until last. The natural consequence of doing asset protection, like I'm describing, can result in tax on passive income being reduced from 50.13% all the way down to 26.5%, and capital gains, if you have real estate you're selling, from 25% down to 13.25%. I'd like to thank you very much for your time and attention today.